It's 12 p.m. Eastern time on the dot. Should we get started?
Yeah, let's do it.
Perfect.
Let's rock and roll.
So thank you everyone for joining today's workshop hosted by Zoe Financial. We're very excited to have you here. I'll get started by reading a brief disclosure. So this presentation is not to be taken as investment advice and should not be relied on for such advice or as a substitute for consultation with professional accounting, tax, legal, or financial advisors. The observations made are independent of Zoe Financial and should not be read as financial recommendations. So with that, I'll introduce our host, Andres, and tell you a little bit about the webinar that we're going to have. It's on navigating economic uncertainty with asset allocations. Andres is the CEO and founder of Zoe Financial. Prior to Zoe Financial, he was an executive director at JP Morgan Asset Management, where he helped oversee $300 billion in assets. He is a CFA charter holder and obtained an MBA from the Wharton School of the University of Pennsylvania, where he received both the Joseph Wharton Fellowship for Outstanding Record of Academic Achievement and the Toigo Foundation Fellowship. So with that, I'll leave it to you, Andres.
Thank you so much, Isa, and thanks so much for the marketing team for putting together this great webinar. So before I introduce our rock star guests here, the topic for today is navigating economic uncertainty. And specifically, we're going to talk about how you could use asset allocation as a way to navigate this tough economic environment. So with that, let me introduce our panelists. So Gloria Schuldes is a CPA. She's a registered investment advisor, also with a Series 65. She's a mother of toddler twin girls. So as you can imagine, she's busy. She provides high net worth individuals, families, and business owners with comprehensive wealth management services, including tax and estate planning, risk management, and retirement planning to help them meet their objectives. Prior to joining Mariner, she worked as a controller for Pumpman. Prior to that, she was an accounting manager for PKF O'Connor Davis, specializing in compliance and planning for individual partnership and corporate tax client. And Gloria has a bachelor and master's degree in business administration with a concentration in accounting. So Gloria, thanks so much for joining us. I think it's the perfect guest for this topic.
Yes, no, thank you. Thank you for the introduction and having me on as your panelist. You do mention I'm busy, but it's a great busy. I'm having so much fun at this point of where I'm at in my career and with my wealth management clients.
Great. And one thing that actually is not here, Gloria, if you want to give it a little bit of sense of the firm as well, yeah, that would be super helpful. Yeah,
sure. So Mariner Wealth Advisors, were a nationally ranked RIA, like you said, registered investment advisor firm. We have over 80 locations within the country. We've actually hit the over 100 billion mark in assets under management. And we provide different services, not just investment management services, but what we call the 5 services that become what clients view us as their personal CFOs. So anything that has a dollar sign in front of it will perform that type of service and be able to help guide that family or individual.
Perfect. And I think this will also show us as we talk about this topic later on the taxes front for sure. Great. All right. So let's get started. And just to set the stage, here's the agenda. First, we'll talk a little bit of macro before I go into the meat of it, which is understanding your risk tolerance, understanding the importance of the different asset classes you could use in a portfolio to build a well-diversified asset allocation strategy. We'll also talk about risk management strategies, techniques, and then lastly, we'll talk about tax considerations. So just to set the stage as to, we get a lot of questions from consumers, from individual investors, more than ever, considering how much uncertainty there is when it comes to the economy. And you don't have to look much further than 2 major topics that are creating a lot of uncertainty. The first one is inflation, right? So this chart is looking at the consumer price index going back to 1970s. It's essentially a basket of goods and services that you and I buy, and is showing how much the price of those goods and services changes throughout time. And as you can see, in the 70s, we had a lot of ups and downs when it came to inflation. But since then, it's been fairly steady, especially over the last 20 years. Inflation was kind of in that, call it 1 to 3% consistently, especially for core CPI, which is kind of the main basket of goods and services that are less volatile that we buy. But if you notice since COVID, essentially, right, post-COVID, inflation has really taken off. It's surged, right, from that 1 to 3% all the way up to 9% for headline CPI and for close to 7% for core CPI. Since then, it has started to come down, but when inflation kind of gets dislodged like this, it creates a lot of uncertainty, not just for from a perspective of the economy, but for markets as well, as we'll discuss in a little bit. So this created the kind of environment where people are really not certain what next year will look like versus this year, considering inflation went from 1 to 3 historically to closer to 9, right, at its peak. And then on the other side of the coin is not only inflation that's become a concern, is as the Federal Reserve has raised interest rates to try to get inflation under control, the economy is starting to slow down, right? When the Federal Reserve raises interest rates, it's the equivalent of throwing cold water right at the economy, right? If it was getting overheated, it's trying to slow it down. And we could actually see that here in this chart. So what this chart is showing is what each of these indicators are, or variables. They're indicators to give you a sense of the pulse of the economy, right? Real personal income, non-farm payrolls, household survey for employment, real consumer spending. These are all kind of indicators to give you a sense of how the economy is doing. When you see green, it means the economy is growing, right? Each of these indicators are in good standing, if you will. When you see yellow, it's starting to become sluggish. And when you see red, and for instance, you can see a lot of red in March, April of 2020, right? When COVID hit, it's essentially you're in a recession, right? It's a leading indicators, some cases lagging indicators, for the most part, leading indicators that you're in a recession or heading into one. So if you look at where we are now for the most latest data, right? January, February data, you could see that a lot of items that were in the green as of mid year of 2022 are now in the yellow, and some, like real consumer spending, are becoming kind of like orange, right? So from that perspective, this gives you a sense also why there's a lot of concern out there, is that the economy is not as in good standing as it had been in prior quarters. There's a lot of concerns that at some point this year, we will actually hit a recession, right? So that sets the stage as to why we're having this conversation, is that there is a lot of questions as to what this might mean for investors' portfolios. So with that in mind, the first topic that we wanted to hit is understanding risk capacity and risk tolerance. That is the most essential, first step before you decide what you should be doing in this type of environment, is to try to understand risk capacity and risk tolerance. And Gloria, I'll let you take away just describing first what risk capacity is.
Sure. So let's kick this section off, and why we're starting off talking about risk capacity and risk tolerance first. Really, it's because your asset allocation that will work best for you at any given point in time will depend and be determined by these factors, right? So you're more likely to stay invested when you find that level of risk that's just right for you.
Right.
So risk capacity is about whether you can financially afford to take a certain amount of risk with your investments at a particular point in time. So you either have time to bounce back from your losses, or you don't. So really, risk capacity, just in its simplistic form, is, are you able to?
Right. Can you give us an example of like, a client or, a circumstance where the risk capacity was not there? Maybe the client was not aware, right, that the risk capacity was not there for the risk they were taking.
So an example could be, we have young folks that are wanting to buy their first home, but they're also young, and we have that time horizon, which we're going to talk about later, with being able to grow their assets too. So they want to be aggressive in the market, but they also have to understand that at that point in time, they're able to have those short-term, safer investments that are needed to purchase with liquid cash that home. So
yeah,
there's
that's a
that
great
balance
example
of capacity.
Right, right. And that leads perfectly to risk tolerance. And in this example, maybe they might have had the risk tolerance to, buy their whole portfolio in stocks, but they needed that cash on the side to buy that house, right? But yeah, let's now describe what risk tolerance is.
Sure. So there's risk involved in your investments. So building a personalized plan around your risk tolerance is important. Like how much risk you are willing to accept. As with any type of investment, there's always risk. So here it's about how much risk you're able to withstand. So example, if you have a low risk tolerance, you may sell your stocks that you have for the very first time when they start to dip. And this is important for an advisor to understand about his or her client, right? Because then we can decide what types of investments to make. But also having that advisor takes that emotion out of making those rash or uneducated investment decisions. And on the flip side, an aggressive investor or one that has that higher risk tolerance is more likely to risk losing money in order to get those better results. So going back to that more conservative investor or one with that lower risk tolerance, they tend to favor investments that will preserve, his or her original investment.
Yeah, no, that's perfect. And I think, going back to that example you provided, in this case, that client might have had very high risk tolerance. And I think it leads perfectly to the next slide here that you have, which is kind of balancing that risk tolerance and capacity with the reward that you're getting from the investment. So let's talk a little bit about that.
Right. So this is a big one. So now that we understand more of what risk capacity and risk tolerance are, and there are different types of portfolios that we could construct. So we could discuss the investment options, potential risk and returns within them. So we're going to be talking about asset classes in more detail a little later in just a few more slides. So let's stick to that far right column, even with just the investment options that have different risk and rewards. So all investments do involve some degree of risk, and the reward for taking on risk is the potential for a greater investment return. So these risk options that are in this stock class, historically, they have that highest, greatest risk and highest returns among the three major asset classes, which would be the stocks, the bonds, and the cash. And as an asset class, the stocks portfolios really are the heavy hitters that do offer that greatest potential for growth. The stocks do hit home runs, right? But they also strike out. So there's that volatility of stocks that make them pretty risky investments in the short term. And just as an example, with the large company stocks as a group, you have them losing money on average, maybe about 1 out of 3 years. And then sometimes they even have quite dramatic losses. But investors have to be willing to ride out those volatile returns of stocks over long periods of time. And they generally have been rewarded with positive returns. So that's why starting out at that top of the totem pole with the stocks, those are the higher risk, higher returns. Then, Then we could go on to then we could go into the bonds, and they generally do have less volatility than the stocks, but offer more modest returns. As a result, the investor approaching a financial goal might increase his or her bond holdings that are relative his or her stock holdings, but the reduced risk of holding more bonds would be attractive to the investor despite that lower potential return for growth, right? So you should keep in mind that certain categories of bonds offer higher returns, like that are similar to stocks. And that's why that is kind of on the higher tier of risk and reward too. And those would be that high yield or junk bonds category, because they do carry that higher risk. The third asset class, which again, we're going to dive deeper into the classes later on, but within that investment options would be cash. So the federal government does guarantee many investments in the cash equivalents. The principal concern for investors here investing in cash is that inflation risk. This is the risk that inflation will outpace and erode those investment returns over time. So yes, in trying to be conservative, you also have to think about how your monies are keeping up with inflation.
Perfect. And then it's not just about balancing risk and reward, it's aligning time horizon, right? Like with those investment risk. So let's talk a little bit about that. And I think the example you gave on the purchasing the house, I think is a good one also to kind of follow through here.
Yeah, I'll do that. That will definitely be one of these three buckets. The period of time expected to hold an investment until the investor needs that money back. So this bucket approach to asset allocation helps plan your cash flow. And let's start off on the left side with that short term. So typically this is between 2 and 3 years. So let's say buying a home or a car. So this will be a more conservative approach for an investor to be in their portfolio. So we want investment options such as savings accounts, CDs for short terms, money markets, choices that could be easily liquidated for cash. And then medium term bucket, right? This would be maybe 8 to 10 years out. So maybe a family saving for college for their kid or kids. They'd want most likely maybe a mix of stocks and bonds. And then a third time period is that long-term time horizon, which for many and most, the first thing you think about is that retirement, or we like to also say financial independence. This might be a 15 plus year event that we're working towards. So we could be more aggressive or riskier with greater risk for greater reward, right? So remember, the longer the time horizon, the longer the power of that compounding that it has to work towards.
Perfect. And I think, we use the word asset allocation and asset classes. So I think this next section, I think is key here to just kind of define them, and then think about it maybe like what these ingredients are, maybe on asset classes, right? When we talk about building a portfolio.
Yeah, so this is a big one. So with asset allocation and asset classes, I want to talk about here really the asset classes, because asset allocation is one of the most important decisions to be made. And many have a significant impact on a portfolio's investment returns and growth over time. This is a process of dividing a portfolio among those major asset classes, so such as cash, bonds, stocks, real estate, private equity, commodities. The goal of the asset allocation here is to reduce risk through diversification by having exposure to a variety of investments that perform differently during various market conditions. And this is why asset allocation is so important, because by including asset classes with investment returns that move up and down under different market conditions within a portfolio, an investor can protect against significant losses. Historically, the returns of 3 major asset classes have not moved up and down at the same time. So market conditions that cause one asset category to do well often cause another asset category to have average or poor returns, right? So by investing in more than one asset category, you'll reduce that risk that you'll lose money, and your portfolio's overall investment returns will have a smoother ride, right? So if one asset's classes, the return falls, you'll be able to be in a position to counteract your losses in that asset category with better investment returns in another asset class. And then why asset allocation has a major impact on whether you will meet your financial goals. If you don't include enough risk in your portfolio, your investments may not earn that large amount of return that to meet your goal or goals. So I guess for an example, right, if you are saving for a long-term goal, such as we'll keep with that retirement or college example. So most financial experts agree that you will likely need to include at least some stock or mutual funds in your portfolio. And on the other hand, if you include too much risk in your portfolio, the money for your goal may not be there when you need it. I think that was a lot for.
Yeah, no. I put the next slide here because you started talking about different types of portfolios essentially.
Yeah. Yes. No. It all intertwines. That's why this is these are big topics that you deep dive. Keep it high level or go into very specifics for them.
Yeah, I think that we could go into explaining a little bit, kind of an actual practical use case of how that asset allocation would look like in this slide. We call it the quilt chart here with a lot of different colors.
Sure. Yes, the colors, fun, from light blue to dark blue to medium blues. So really with this quilt chart, we're demonstrating how a balanced portfolio is an output of doing asset allocation right. And we are looking to be balanced. So that's what we're highlighting here in that yellowish orange. And we don't want to go through major deviations or swings in indexes throughout the years, because on their own, they are volatile. And it's evident by that zigging and zagging lines of performance. So just pointing out commodities, say in 2020, you could see the lowest end of the totem pole in 2020 is commodities with a return of -3. But in 2022, then it had a return of 13%. So it's a large disparity, and comparing to the other investments during those times, you just don't want to be heavily allocated and putting all of your ducks in a basket in one sector.
Yeah, absolutely. And I think this is a perfect segue here to risk management, because when we talk about asset allocation, one of the aspects of why you do asset allocation is not only to kind of get a certain type of return profile, but it's a type of risk mitigation. So maybe we'll start with just kind of defining what diversification is, and then we'll go from there.
Sure. We mentioned diversification a few times here or within the presentation. So let's actually dive more into the details with so really it's I'd say the practice of spreading money among different investments to reduce risk, right? So by picking the right group of investments, you may be able to limit your losses and reduce the fluctuations of investment returns without really sacrificing too much potential gain. And a diversified portfolio should be diversified at two levels. It's between those asset classes, but also within the classes. So in addition to allocating your investments among stocks, bonds, cash, and even private equity and commodities, you'll also need to spread out your investments within each class, within those investment options like we discussed. And the key here is to identify investments in segments of each asset class that may perform differently under different market conditions.
Perfect. So that's one type of, call it a risk mitigation, right? Is diversification or risk management. Rebalancing is another one. So maybe just walk us through what rebalancing is and how it helps.
Right. And this is big, especially now with the market volatility. It's understandable that investors may be concerned about their investments. Having the volatile markets can make you wonder if you are on the right track to meet your goals. So really here at Mariner Wealth, we say, don't panic and instead be proactive. Rebalancing is a step to take in both up and down markets. This will readjust your portfolio back to the original investment strategy. And essentially, when you rebalance, you tend to sell some appreciated assets and purchase others with lower valuations. Regular rebalancing may increase the overall return of your portfolio over time. Additionally, I guess while going through rebalancing, I'm going to talk about task loss harvesting later, but here the opportunities will arise for that and we could monitor them as well.
Yeah. Yeah. From this perspective, before we get into taxes,
right,
is the ability to just keep your portfolio's risk profile where it should be rather than letting the market dictate, right, where it is.
Right. It's being proactive. And really here at Mariner, we're regularly looking at this for our clients' portfolios to see if rebalancing needs to be done. It's not just a one-time event or an event at the end of the year exercise. We'll say the relative weight of an asset class could increase or decrease. more than a certain percentage, say 10%. And especially in those market times, it can and does happen within a short amount of time. So we would miss a good time to rebalance if we only look to rebalance at a specific time period or event.
Yeah, no, that makes sense. Okay, so now we could talk about, which you could tell as a CPA you are dying to talk about,
yes,
which is tax considerations. So let's start with asset location, which is often, we talked about asset allocation, but asset location is equally important. So let's talk a little bit about that.
Right. And this is something that's missed or not understood enough. And we like to really teach and explain this. So when we are considering investments and considering accounts, the biggest thing to focus on is asset location. So do you have the right type of investment account in your retirement account? Do you have the right investment in a taxable account? So we can move assets around and keeping the same asset allocation, which would be important, but help put them in a more tax efficient structure. So what this might look like for retirement accounts, we like to see income producing, high yield dividend funds, such as real assets and bonds in a retirement account. That's pretty smart. So the goal here is to minimize income taxes and maximize after-tax return on your portfolio.
Yeah, no, that's a big one. And what about tax loss harvesting? We were just talking about rebalancing before, and this is kind of maybe a component of what could, a benefit of rebalancing.
Yes, and this one, again, always having that tax hat on and tax lens through investments. I might take this for granted that people understand tax loss harvesting and already do this on their own, even when they come to us or with pre-existing advisors. But I just want to make it clear on the technical rules before jumping into how to actually perform the tax loss harvesting. So to calculate your capital gains liability, you realize capital gains are netted against your realized capital losses. And to offset large gains realized during the year, you may consider selling any of your unrealized losses to lock them in. And this strategy is what is called tax loss harvesting. And then in its simplest form, investors should consider seeking to replace any asset sold with a similar stock or fund or ETF, really in order to preserve that balance of the portfolio and to maintain that market exposure, right? You don't want to sell and be out of the market and stay in cash. So we like to say a good example is Coca-Cola stocks fall 10%. You sell the position to harvest the loss and then replace the exposure with a similar company such as Pepsi, right? We all know Coca-Cola and we all know Pepsi. So this is a process that we monitor and perform for all investors that work with us to sell their stock and other investment losses during the years in which income is higher and keep an eye on reducing those capital gains whenever possible, right? So if your capital losses are greater than your capital gains, you'll be able to deduct up to $3,000 of losses against ordinary income. And those losses that are greater than the limit can be carried forward to future years. And I'm going to end by saying that this is a pretty powerful concept since it not only impacts that current tax year, but future tax years as well.
Yeah, that makes a ton of sense. And on the third one, on the $3,000, is that the most you could deduct when it comes to tax loss harvesting per year?
Correct. And then it gets carried forward. And it's a great tool to have because you could have $100,000 gains. Just as an example, this past tax year, we had a client that had heavy international, was weighted heavy in international, and he had a large gain, unrealized gain. So we had him sell. We wanted to have him sell, but we didn't want to create a large tax burden for him. So we were also throughout the year, because 2022, as we know, with the markets, we were able to capture other losses within his portfolio to offset that gain. So you use it as a strategy. And once you hit that 3,000 loss, then you carry it forward for future years.
Right. So it's 3,000 per year. But if you do this every year for a couple of years, it could, it ends up being a pretty significant number.
Correct.
Got it. Yeah, no, this is a big one, and one that a lot of people, to your point, kind of miss it's essentially the closest thing to a free lunch that people miss, right? And it takes some work, which is obviously why a lot of people end up doing it with an advisor, because you kind of have to go in there and figure out on your own. But is one that the first time, I hire an advisor and they started doing it for me, it's like, oh my God, this is the closest thing to a free lunch that exists out there. So thanks so much for giving us a little bit of context there. And I see there's a couple questions on it, but we'll get to the Q&A in a couple minutes. Just we end the formal part of the presentation with this question, which is, Gloria, why did you become a financial advisor? And also gave us an excuse to put this picture in there.
No, this is great. Really, I just love helping people and communicating with people. I was in the CPA firm. That's where I grew up, so to speak, for 10 years. I feel like I only saw one side of the picture within the wealth management realm. So being able to come to the dark side of wealth management and planning, now I'm able to also be that, like I said, quarterback, personal CFO to help a family or individual within anything that has that dollar sign in front of it. So whether it be insurance, taxes, investment management, wealth plan, cash flow planning, wealth planning, I could see the big picture, and we really become their family and get to know their family.
Yeah. By the way, now that I look at this picture, I realize it's Bluey characters.
Yes.
I love that show. Like, I think I like it more than the kids.
I know.
At my house.
Yes.
I joke with my wife. I'm like, I think I learned how to be a better father by watching this show. So I think I'm learning more than the kids are learning from it. But what a great show.
Yes, that's what I hear from a lot of parents. The kids like Bluey, but they like Bluey more.
I'm like cracking out more than they are by watching it.
Yes.
Or it's good to see that they're big fans. This is a great outfit for.
Yes. Yeah, this was.
I would say for this age, I would say maybe not even for Halloween. Like maybe they're just wearing this around the house.
That's a good idea. I'll bring it back.
Yeah, exactly. Awesome. Well, thank you so much for sharing. On the personal side, why you became a financial advisor. The next stage here, we just like to put this slide up because every time we do a webinar, this question comes up on, great, this sounds super helpful. How could I hire someone like Gloria, right? Or Gloria. So what Zoe does, right? Why we exist is to connect people that are looking for answers, right? And a service like wealth management to connect them with a top advisor that could solve that specific problem that they're looking for a solution. So how you could go about it, to connect with Gloria or someone like Gloria, depending on your specific situation, is you could either call, right, 646-680-9244. You go to our website, zoefin.com, and fill out a short questionnaire that will help you match with the right advisor, or you could email us at concierge@zoefin.com. Our concierge team could help you, if you want to speak on the phone or via email. That's kind of all the different routes, even text. A lot of people like text now. The concierge desk will text back and forth. So that's a little bit about us. And I answer it up front because I already saw one of the questions that came up on that. So with that, we'll open it up here to the Q&A section. And there's a bunch of questions already, but if you have questions now, you could go to the Zoom bottom of your screen and just type in questions there. We'll see them on our side. So I'll start here with a pretty broad one that, here's one that's pretty specific. So the question is, what would be the best way to get started on tax loss harvesting today? Like maybe like mechanically, how does that work?
Right. So in a simplistic form, I would look at your taxable account. So I think that's a big thing too, is you don't tax loss harvest in your retirement accounts.
Like an IRA or like that, you won't be able to do it there.
Correct. So look at first your taxable accounts and then look at your unrealized gain or loss from that account. So your cost basis versus your market value, that difference is going to be your unrealized gain or loss. Positions that you see losses in, that's where you're going to want to start. And typically we'll look at losses maybe over $1,000 and start looking at, what sector they're in, what asset class they're in, and see if we rather sell that position and buy a similar position to keep within the asset class allocation, or maybe we need to, this is a good time to see though too, do we need to rebalance? Are we underweighted or overweighted in one class that we can sell that has that loss and go into another? So tax loss harvesting and rebalancing really go hand in hand. You could do it simultaneously and accomplish the same goal.
Perfect. So there's a macro question that I'm happy to take a stab, and you feel free to jump in.
Sure.
Gloria, is the age of easy money over, and what impact will that have on markets? So going back to the first slide that we had on inflation, right? And maybe I'll just pull it up real quick here. The question of the age of easy money is that when inflation was very low, the Federal Reserve kept interest rates very low as well. In fact, at zero, right? And what that created was an environment of a lot more risk-taking, right? Investors, if they kept their money in a savings account, were getting zero returns. And as a result, they were basically saying, well, like the only way for me to get any type of return is to buy stocks or buy, private equity, venture capital, like the most kind of risk-taking asset classes to get any type of return. And that definitely was kind of the age of easy money, right? Where basically the cost of capital was zero. As to the question of, is the age of easy money over? Look, right now it is, and it's, that's not a prediction, is just the reality of the fact that the Federal Reserve raised interest rates, from 0 to 5%. So from that perspective, they have, going back to that analogy of, throwing cold water into the economy, and other ones, taking the punch bowl away from the party, that is essentially showing us that the cost of capital is much higher. So yeah, I would say that the answer to that is yes. I'm not even predicting, it's just like where we are right now. As to what happens next, right? There's a lot of moving factors, right? If inflation were to come back down to 2% and stay there, the Federal Reserve will have more wiggle room to lower interest rates, and therefore the cost of capital would drop, and it would become easier, right, to borrow money and to invest in riskier assets because the other options are not there. But right now, we're definitely in an environment in which you could get, on a savings account, you could get over 4% return, which means that for investors, when they look at stocks, for instance, or bonds, specifically bonds, they might say, why would I buy, a 10-year treasury bond that's yielding the same or less than my savings account, right? Why take the extra risk? So we do live right now in a very different regime, if you will, than we did the prior 20 years. And I'll stop there. I don't know if Gloria, if you have any comments on that, and maybe how it fits into the asset allocation type question that we are addressing throughout the presentation.
Yeah, no, you basically hit a lot of that point. Just that inflation, where we're at now, about 6%. We don't see it really coming back down. And many people want it to come back down to that 2-3%, but it doesn't look like it's going to happen at least within the short term.
Yeah, absolutely. Now, there was a specific question here, and feel free to say, hey, like, I don't want to be too specific on the answer here. This question from Herbert, is it good to open a Roth at 69 years old? And I know that this is one of those where it's like, it depends, but feel free to answer it however you prefer.
It depends. It does depend. It depends on the situation. It depends on, your risk age too. How long did your parents live? What's your history like? You can't just open a Roth. What is your tax situation? Are you above the threshold where you would benefit? So there's different factors that would have to come into play with just with knowing if you could open a Roth.
Perfect. This is a question that, is a lot more specific on the investment side, Gloria, so feel free to punt. But it says, can you tell us more about non-liquid assets? And they mentioned, as an example, like land, or, you could use commodities, or, but call it, you're not buying it as a financial asset, I guess is maybe where they look at it, or where your money gets locked in, right? So any questions or, questions you would ask, or thoughts that you have on non-liquid assets?
Keep them diversified. You could, it's fine to have, just make sure you're not overweight in one area or the other. And then also just based on your risk tolerance and your time horizons, why would you want to hold those assets, and what are you trying to accomplish within your portfolio? Yeah.
The one thing to keep in mind that a lot of people don't think about it is that they'll say, oh, look, this has a high potential return profile. But you're locked in, you can't take that money out, right? And as a result of that, in good times, it seems like a great idea. But then when, you hit a recession or the rest of your portfolio is falling, there's nothing you could do with that position. You can't sell it, right? You're locked in. So that's the one thing to keep in mind when it comes to non-liquid, is that sounds like a great idea in the way in, sometimes not as a great idea when you're trying to get out.
Right.
So something to keep in mind.
Yep, you have to see where you're at with your time horizon and what your tolerance is.
Yeah. Okay, so I have a couple more here. Okay, so this one's thoughts on passive index funds versus individual securities, and that's all they wrote. You could speak broadly to it, Gloria. I'll chime in, but just maybe even how you guys as a firm, navigate that.
Yes. We've seen historically, actually, passive has outperformed active management, but within recent times, active management is preferred. So it depends where we're at within the markets, and you just have to stay on top of, if you're doing active management, staying on top of being proactive in trying to understand the leading indicators, where we are getting, these times are hard as an advisor. I think these are the hardest times because we are seeing mixed signals within the indicators. Obviously, we never have a crystal ball, even in times that markets are doing well. But we have to have that balanced approach between active and passive, because you don't know when that time is going to change. But we do have internally managed teams that just focus on performing active strategies for our portfolios on an ongoing basis.
Yeah, and what I would say about active versus passive is that the spectrum of active is also very broad, right? You could buy an ETF for 20 basis points, 0.2%, that have a tilt towards small cap and value that historically have outperformed, the S&P 500. Those factors have outperformed, been empirically proved, and you're only paying 0.2%, right? You don't need to buy a hedge fund to get that type of active strategy. And then within active, there's also full-blown, we only own 8 stocks and we're trying to significantly outperform our index. And as a result of that, we're going to charge a lot more money, right? So when you use kind of the idea of active versus passive, there's a huge spectrum. And what I would say is that the more active the portfolio is, the more scrutiny there should be as an investor of are you really worth that type of fee? Because historically it's not easy, right? To significantly outperform the market for long periods of time. I was in teams that managed billions of dollars. We had hundreds of people in research across the globe at JP Morgan, and it was still nearly impossible, right, to beat the market. So for an individual person to do it, not likely, unless you're like Warren Buffett, right, to be able to do it. But there's also the idea, I don't know if the question also had to do with passive index funds versus individual securities, in the sense of, even if you're trying to be passive, there is the I will own an index fund versus I will own 90 individual securities that mimic the S&P 500. And therefore I'm being passive for all intended purposes. And from that perspective, it becomes a question of how much time do you have to make sure that those individual securities are actually mimicking the market, because they'll move in different directions and your portfolio risk might change drastically, which is now maybe what you intended. So there's kind of the effort involved on keeping a portfolio of individual securities versus the passive index fund, which will do it for you, right? And those are all considerations that you would talk to your financial advisor, or that you would have to kind of do on your own. But all very important questions to kind of answer before you pick one or the other. All right, so I see here a question on, this is kind of a broader question that I think maybe a good segue here to end it on, because I see a couple other questions are very similar, is, how do I know how to trust the person that that's going to help me with all this stuff, right? And that one hits home because that's the reason we started Zoe Financial, is that we thought the range of competency of financial advisors is very wide, and the bar to call yourself a financial advisor is very low. So as a result of that, you have advisors like Gloria's that are CPAs, that have years of experience, that have a master's, and clearly could help somebody in a number of different factors of their personal financial life. And then you have other advisors that call themselves advisors that were selling cars, a year earlier, but now they're selling you products, right, on the financial side. So it is really important who you trust when it comes to your finances. And the reason we exist is because we're running due diligence of all the practices as well as the advisors at the advisor level to make sure that they have the competency and they have the aligned incentives to help you, rather than to sell you an annuity to get a trip to Hawaii, right? Because they got a commission. So that one hits home. That question hits home for sure. Because, before we started Zoe, I knew a ton of people that had people giving them the wrong advice for the wrong reasons. And it could really alter your life, right? This is money that you work very hard to save and invest and grow. So definitely be very careful about who you trust. You could obviously use us, but if you want to do it on your own, just ask questions. A lot of questions. We have content on this. So whoever asks this question, if you want to email us, we have tons of content on questions to ask when you're interviewing advisors through Zoe or outside of Zoe, to make sure that that you're put in trusted hands and someone like Gloria that really knows what she's doing. So with that, maybe as a segue to end it, Gloria, thanks so much for taking the time to go through this material. It was super helpful. We know you're really busy with your clients, with your twins, and we really appreciate your time.
No, thank you. This is great. Thank you to the marketing team for putting this together. Thank you for Zoe for reaching out, and I'm honored to be a part of the panelists.
Great. Thanks so much, everybody, for joining us, and stay tuned via email for future events that we'll have in the coming months. Have a good one.